Good morning, this is Tim McGowan for the Finance News Network. Stocks closed high on Monday in a volatile trading session ahead of the Fed Reserve's two-day policy meeting slated to kick off on Tuesday. Of course, it's rates week. The Fed will join the central banks of England, Norway, Sweden and Switzerland in raising rates this week. All eyes will be on the Fed with a consensus estimate for a 75 basis point increase. The Fed's rate increase, of course, is having the most direct impact on US housing. Mortgage rates climbed above 6% last week for the first time since 2008. Rising borrowing costs have slowed home buying significantly, though the effect on home values has been muted. Prices appear to still be rising in most parts of the US, though much slower than they once were. Yields pushed higher overnight ahead of the Fed's rate decision, with a 10-year Treasury yield topping 3.5% and it hit its highest level in 11 years. Rising yields now present investors with an alternative. The gap between the S&P 500's earnings yield and the returns from cash or high-grade shorter duration corporate bonds has narrowed significantly. Given that equities are a lot choppier these days, it must be starting to get tempting to rotate back into bonds. The US 1 to 5 year credit yields are now around 5% against the S&P 500 earnings yield of around 6%. But over the last 30 days, the S&P 500 has been 5.7 times more volatile. In short, investors are now have a number of high-yielding, low volatility alternatives if they want to step back from the market. Of course, the argument for bonds rather than equities is further strengthened when you consider the impact of a possible global recession on equity earnings. To the markets now, overnight the Dow jumped 0.64%, the S&P gained 0.69% and the Nasdaq added 0.76%. Stocks wavered between gains and losses throughout the session, with the Dow down as much as 263 points earlier in the day. At session lows, the S&P 500 and Nasdaq shed close to 1%. 9 of the 11 S&P 500 sectors ended the day in positive territory, led to the upside by consumer discretionary and industrials. Financials also rose as some investors bet that higher rates could benefit their bottom line. The materials sector was led by gains in aluminium, copper, steel and iron, agricultural stocks. Healthcare and biotechs were the laggards, falling after comments from President Joe Biden indicated that the pandemic was over. Vaccine stocks were hit hardest, with Moderna off 9% and BioNTech down 8.5%. Overnight, Volkswagen announced that it planned to sell shares in the luxury sports car brand Porsche at a valuation of up to $75 billion. The news marks one of the last steps in setting up one of the biggest IPOs in years, at a time when the market for taking companies public is particularly challenged. In aftermarket news, Ford Motor warned investors that the company expects to incur a $1 billion more in costs than expected during the third quarter due to increased costs and supply chain issues. Ford said that supply problems had resulted in parts shortages affecting roughly 40 to 50,000 vehicles that haven't been able to reach dealers. Shares of the company fell about 5% in extended trading following the update. On the currency front, one Australian dollar is relatively flat, buying 67.3 US cents. In commodity news, iron ore futures are pointing to a 0.4% fall, whilst no major movements from other commodities despite strong commodity stocks overnight. Oil, of course, added 0.7%. On the SPI futures this morning, they're pointing to a 0.8% gain. This is Tim McGowan for the Finance News Network. Have a good day.